Being the recipient of philanthropy is a blessing and a significant responsibility. Your community must be prepared to receive, count, record, protect, spend, and report on the money you receive. To do this in an accurate, honest, and transparent way requires effective controls and the regular monitoring of finances. Most pastors are reluctant stewards of financial oversight and the systems needed to receive and manage money. In the same way, one can assume that many community leaders also feel this way. Poor control and management of money has been the downfall of many individuals and organizations through the years, including churches and faith-based nonprofits. To avoid this, new worshiping community leaders need to find their specific role within the ministry of money and exercise their particular authority in this area. Establishing the proper protocols and controls at the start of your community will keep you from a negative experience with money. It is also important early on for a community to have a bookkeeper who is fluent with double entry accounting, which is the basis of all computer-aided bookkeeping systems available today. Well, as a leader, you don't have to have a detailed knowledge of bookkeeping. You need to have a working knowledge of church accounting, understand basic financial reports, and be able to lead a budgeting process. To receive money and avoid income tax consequences, a community needs to be an entity independent of any individual. This status is established by incorporating in the state within which you are located, or obtaining a fiscal sponsor, such as a presbytery or an established congregation. There are also some crowdfunding organizations that offer fiscal sponsorship. Although the process may differ state by state, corporate status is obtained by developing articles of a corporation, choosing a board of directors, establishing a corporate name or DBA, and paying a fee. Corporate status does not give an organization the ability to receive funds on a tax-exempt basis, however. That more difficult procedure is done through the IRS, usually with the aid of an attorney. Fiscal sponsorship is a much easier route for a newly emerging community. Depending on the level of accounting knowledge of the community's bookkeeper and the willingness of the fiscal sponsor, this arrangement would require a community to prepare a budget, open a checking account, collect cash donations, pay expenses, do account reconciliation, and produce financial reports. At the same time, the fiscal sponsor would handle payroll and financial reporting within its larger framework. The division of accounting responsibilities must be clearly delineated in order that the community's finances are maintained in an accurate, honest, and transparent manner. Money may be received in cash, by check, through apps such as Venmo, through a fee-based payment service such as PayPal, or through the internet into a secure portal. All funds collected must be tracked and attributed to the individual or organization that made the donation in order that year-end totals can be provided to each donor. Money collected through an offering should be counted by two people, neither of whom are the community's bookkeeper, and deposited in the bank in a timely manner. The counters should prepare a report of each offering, noting the amounts paid by cash and check, and provide this report to the bookkeeper for reconciliation to the deposit. A guide to the duties and protocols for handling money may be found in the 1001 resource page, newchurchway.org. An easy, secure, and economical way to handle online donations is through the online giving program offered by the Presbyterian Foundation. They can be reached at presbyterianfoundation.org/online giving. Let's talk about church accounting. Once your community has received money, how do you accurately capture and record financial transactions, meaningfully measure progress toward the financial goals, and clearly report the results in a way that is transparent, honest, and helpful in making decisions? That is the function of accounting. There are 6 aspects of church accounting that a leader needs to know about: the types of accounts used by churches, the purpose of month-end and year-end closing, the accounting method that the community chooses, the purpose of funds and how they work, the difference between unrestricted, temporarily restricted, permanently restricted, and designated donations, and the importance of a gift acceptance policy. Let's talk about the types of accounts. Every financial transaction that occurs in the community is recorded simultaneously in at least 2 accounts. Asset accounts record the things that the community owns, as well as things the community has a right to take possession of in the future. Examples of assets are cash, equipment, and buildings. Liability accounts record what the church owes, as well as probable obligations in the future. Examples of liabilities are accounts payable, mortgages, and other loans. Net assets record the difference between assets and liabilities. At the end of the year, the community's financial position is defined by the difference between what is owned and what is owed. Revenue for communities consists largely of tithes and offerings, although they may also include rental income, income from fundraising events, and other items. Expenses are outflows or using up of assets to carry out the community's operation and mission. Examples are office supplies, compensation, and utilities. Asset, liability, and net asset accounts are permanent accounts that provide a snapshot of the community's financial position at a certain point in time. Their balances carry over from year to year. Revenue and expense accounts, however, are temporary accounts that quantify the activity of a community over a set period of time. These are closed out at the end of the year and may be closed out at each month end. Month end and year-end closing. All accounting systems have a year-end closing, at which time their balances are closed out to net assets. This may also happen at month end. Closing allows a community to compare one period's revenue and expense to another, important for financial management and budgeting. Let's talk about accounting methods. Accounting is carried out using one of 3 methods: the cash basis, the modified cash basis, or the accrual basis. The cash basis is the simplest and probably the method most used by new worshiping communities, particularly those starting out. In a cash-based system, contributions are recorded only when cash has been received and expenses logged only when cash has been paid. In this method, no liability accounts are necessary. New worshiping community leaders don't need to understand each of these, only the method that their new worshiping community has chosen to use. Funds. Funds are used to separate certain contributions, expenses, and assets of the community from other contributions, expenses, and assets. This is a simple way to ensure that a contribution is used in the manner designated by the donor. Most contributions to a community will be unrestricted. For example, cash from a collection. Restricted donations are contributions made by a donor for a specific purpose. These donations may be temporarily restricted, such as a building fund, or permanently restricted, such as an endowment. Communities are legally bound by these restrictions. The restriction on a donation can only be changed by the donor or by a court if the donor is no longer living. At times, a community's leadership may designate or set aside funds for a specific purpose in a designated fund. Unlike a restricted fund, the designation established in a designated fund may be changed any time by the community leadership. What is a gift acceptance policy? A gift acceptance policy restricts the kind of non-cash gifts that a community can accept and who can accept them. Such a policy is established to protect the community from accepting a gift that is not in its best interest. An example would be a gift of property that has serious environmental problems. One important inclusion in a gift acceptance policy is a statement declaring the community's right to remove any restriction placed by a donor if it is deemed to not be in the best interest of the community. Sample gift acceptance guidelines are available at www.ecfa.org. Let's go to financial reports and statements. As community budgets get larger and the financial stakes get higher, leaders will want to have monthly financial reports to manage the community and make decisions. If financial transactions have been logged on a consistent basis, such reports should easily be produced by accounting software used by the community bookkeeper. In addition to monthly reports for internal use, a community may want to produce an annual financial statement to share with the community and possibly others on the outside. On a monthly basis, it is common for church finance committees who are using the cash basis method of accounting to review 3 reports: a cash activity summary or bank reconciliation report, a fund activity report, and a trial balance report. The summary of cash activity report provides a summary of the major categories of receipts and disbursements. Where did our cash come from this month, and where did we spend it? As you can see in this slide, the report begins with the amount of cash at the beginning of the period, adds the total income, subtracts the total disbursements, and finishes with the amount of cash at the end of the period. The ending cash balance should agree with the balance of cash in the community's other reports. The fund activity report provides detailed information about the activity within each fund of the community. This report form, from left to right, lists 5 separate funds, shows the beginning balance in each fund, the amount of receipts and disbursements, and any transfers made between funds, and the ending balance in each. This report can show activity for a month or provide year-to-date activity. The trial balance report is a listing of all accounts used by the community and their balance at the time when the report is run. Each account will have a debit or credit balance, and the total of all debits must equal the total of all credits. By looking at this report, one can see that the normal balance of an asset or expense account is a debit, while the normal balance in a liability or net asset and income account is a credit. If the total of debits is not equal to the total of credits, then the error has been made somewhere in the accounting system. At year end, the community should prepare a financial statement to be included with the monthly reports. The statement prepared when using the cash basis method of accounting is the statement of cash receipts and cash disbursements. Sometimes called an income statement or statement of revenue and expenses. This statement should list cash received by the community, followed by cash dispersed. This statement provides the beginning and ending balances in the cash account. It is helpful to also provide a comparative prior year or budget information on this statement. Well, what about budgeting? While it's not a confession or creed, a budget is a statement of faith responding to what God has called a community to be and do. What a community allocates in its budget for is, in the end, what it does. At the beginning of a community's existence, the budget should flow out of the vision, statement, and mission plan developed through the Starting New Worshiping Communities Guide. To set the context for budgeting as the community grows, a leader will want to involve more community's participants in discerning the mission for the coming year. This will foster deeper commitment to the mission of the community and a greater enthusiasm about giving to support that mission. After leading participants through a discernment process, collecting what has been discerned, and looking for common themes, comes the planning phase. In this stage, ideas are compared to current and previous ministry and non-ministry activities and prioritized based on which best responds to the stated mission of the community. A budget can then be developed that states the community's financial plan for the year and identifies the total amount of money necessary to make it happen. Of course, this plan will need to be reconciled with the capacity and willingness of the community to contribute funds to make the proposed spending possible. The resulting budget acts as a guide for setting priorities and making choices between various activities throughout the year. As the community grows and collects experience in receiving, spending, and managing cash, it is a good idea to create a monthly cash budget that allows for the fact that all gifts and expenses don't occur at the same point. The monthly cash budget is helpful in forecasting and preparing for months when giving is expected to be down, as in summer, or up, such as December, and when expenses may exceed income. In this budget, each month has an expected beginning cash and ending cash surplus or deficit estimate, alerting your community to potential shortages throughout the year. A typical operational budget has line items such as salary, rent, utilities, office expense. You start with one of those. But for mission interpretation purposes, you need a narrative budget in which the operational expenses are divided and allocated to ministry categories such as community service, community gatherings, worship, community development, or other active ministry activities. This budget ties dollars to ministry, helping people see the direct connection between their gifts and ministry impact. It also minimizes the perception that fundraising is primarily for the purpose of paying a leader a salary. You can find the sample reports, budgets, and slides seen in this module at the 1001 resource page, newchurchnewway.org. I hope this overview of receiving and accounting for money has been helpful. If you have specific questions or would like ongoing coaching in fundraising, please contact me at 502-612-5026 or john.moore@pcusa.org. You may also be interested in viewing other financial sustainability modules: an introduction to fundraising, introducing your community to stewardship, or raising money from outside your community. May God bless you and sustain your community.